All right, let's begin the show. If you are new to the world of finance, then you must have come across two words, SIP and Lumpsum investment. Both are used for adding money into an instrument, but here the story is in different quantity and in different periods. So what is this different style of investing? When should you use either one of them? To help you make investing easy and reap more benefits of your investments, today we have on board Tarun Birani, founder and CEO of TBNG Capital Advisors, to tell you the same. Tarun, good evening. Welcome to the show. And we are talking about SIPs today. We just got the AMFI numbers where the SIPs have touched an all-time high, gone beyond 13 crores, that which is the new figure that we have in hand, which also shows that people are investing in the market, but the route that they prefer is an SIP. A lot of investors, in spite of this, do not understand what is an SIP. A lot of time they think SIP is a mutual fund in which they are putting money into. So I go further in the conversation and ask you specific questions on how should you use SIP for creating a corpus on your financial goal. Let's help investors and viewers differentiate between what is an SIP, what kind of investment instrument it is, and not exactly a mutual fund in which they are investing. It's a route, it's a vehicle.
Correct. So thank you, Kavita, for having me here. Brilliant question. I know SIP is one of the buzzword today. We have almost 12,000 crores we are adding on a monthly basis in the country. The SIP is nothing but it's a concept. It is not at all any schemes. It is irrespective of scheme. It's a concept which drives a regular investment structure for the investors. So again, it has been built up based on the challenges with equity investing, because equity investing people tend to keep observing investment returns over a short period of time, which may or may not give you very good returns. So SIP came into existence because that rupee cost averaging, where you have an option to buy 1 lakh rupees today versus dividing that 1 lakh into 10 installment or 6 installment, can help you give more number of observations, and this will help you over a period of time reduce your cost of acquisition, because we have observed that at no point of time market remains same for 10 months. The volatility is always there. So SIP as a concept helps investor to do the cost of rupee cost averaging.
All right, so that's the benefit. But then along with this, there are many other benefits of an SIP. But let's start with the very basic question once again. How many times can you do an SIP in a month?
So I think with the new automated investing systems, I think it is quite possible to do SIP on a weekly basis, monthly basis. And I think there are some asset management companies which are looking at daily SIPs also. Otherwise, instead of SIP, you can take a STP option. The systematic transfer plan is nothing but a larger version of SIP, wherein you can put on a daily basis also. So it is up to the investor requirement, and it's completely flexible.
So you are trying to tell me that you can do it every week, you can take it every month, you can do it every month, or even a yearly SIP that can be, which will be a lump sum?
Yeah, that's correct. That's correct.
All right. A lot of time people don't understand the kind of dates they should be selecting. Are there any specific dates that one should be selecting to do an SIP, or is just spanned out as per your convenience and whenever you have liquidity? Because it's very important to maintain discipline. So discipline not only comes in the time of the times you're doing an SIP, but also discipline the amount that you're investing. So how can one figure this out?
Right. So Kavita, one important point, market tend to move it in cycles, right? It is fueled by greed and fear. That means that stocks are dirt cheap at times, and at another time it are unreasonably expensive at others. So however, equity tend to converge with the genuine earnings potential over a period of time. Investing in SIP over time would result in acquisition of equity at varying valuation, which would average out to the mean. So there was a study done by asset manager regarding the exact question which you were asking, that should I time the SIP or should I keep it variable dates? So the observation of that research study came that regarding the variability in return, based on the date of SIP selected. The interesting conclusion that it arrived was after analyzing the rolling return SIP data for almost 10 years, it made no major difference whatsoever date in the SIP you select. So it is immaterial which date you select because it's a long-term vehicle. Hence, instead of accounting for return expectation, one should select the most convenient date which can help you make it more like a habit. Most of the time, let's say salary gets credited for you at first of every month. So maybe a fifth or 10th could be a great day because the money is available in your account and it would be a good habit builder. The whole idea of SIP is to build healthy habits of investing, wherein like a EMI which you pay for a loan, for your long-term future, you are saving money on a like a EMI concept. So I feel investing is all about behaving correctly, and SIP helps in behaving correctly.
So no, help me also understand how is an SIP different from an RD?
So RD is like a recurring deposit, and it
Yeah.
is used for fixed income instrument like fixed deposits and all that. So wherein bank keeps coming with this RD kind of structure wherein you keep investing at a regular interval, recurring basis. So they give option of daily, weekly also because it again helps in building a habit. But SIP is more in the mutual fund concept, wherein in case of RD, the interest rate more or less remains the same. But in case of SIP, you end up buying at a different NAVs. So the volatility benefit you end up making.
SIPs can be done specifically only in mutual funds or different financial instruments, which would mean shares as well.
Yeah, you can do SIP across financial instrument if you ask me. It is up to you. Any investment which is volatile in nature and which keeps going up and down. So I know a lot of portfolio management services, PMSs have started STP, SIP options also, subject to minimum maintaining a 50 lakh ticket size. I know a lot of discount brokerages have started SIPs into stocks also can be done. So anything which is volatile or variable in nature, SIP will be extremely beneficial.
All right. So now I want to understand from you is what is the difference? Is there any difference between doing an SIP in a mutual fund and doing an SIP in a stock? Does the process is the same, but when we talk about averaging, does it differ?
So we are talking of different animals completely. Okay.
Right.
So
Right.
stock investing requires a deeper research, which to my mind, 95% of the investor doesn't possess that skill to acquire the right stocks at the right time. So stock investing is always most based on the recency bias or greed and fear. And due to that, people keep on getting carried away on the stock part. Again, researching a stock over a period, regular interval, right, quarterly earnings or attending annual general meetings, it's very difficult for an investor, right? But in case of a mutual fund, you are getting a professional support who is taking care of, you have outsourced your investing requirement to someone else. So I feel a mutual fund SIP is much more convenient, but if you have the skill set as well as the time, then maybe a stock SIP can be also be looked at.
And should one also be sure about redeeming the SIPs or the units that they are invested into? What goes into figuring out the redemption of these SIPs or the corpus?
So I couldn't get this question, Kavita. Can you repeat it
So,
again?
for example, if I talk about ELSS, it makes sense if you put money as a lump sum in a lump sum quantity, and if you're doing an SIP, it's very important for you to maintain the 3 years lock-in period for each SIP before you redeem the amount.
Right, right. So you are trying to say that should SIP investment?
So in terms of tax implications, if you want to redeem your SIPs or the money that you've accumulated, how much time should you be giving each and every SIP for tax benefits?
So again, on the equity SIPs, whatever you are doing, any investment which is done for more than 1 year makes you eligible for long-term capital gains. And in case of debt investments, any investment done with a more than 3 year makes it long-term capital gain. So it is always advisable that you need to have this kind of minimum horizon. What happens is when you do the SIP investment, and many people don't understand this. Let's say you started on 1st January 2023 as SIP, and your SIP installment goes for 12 months. So the last unit which we acquired on the 1st December 2023, from there till 1 year, one need to calculate. People tend to make that mistake many times while calculating the capital gains.
All right. And do you prefer people doing lump sum investment in debt and SIP in equity instruments?
So normally debt mutual funds have a certain yield to maturity being quoted for them along with the average maturity of all bonds paper, etc. what they hold. So these YTM tend to change on a daily basis. Like we have seen in last 2 days, the YTMs of most of the debt funds have moved dramatically with the change in the inflation numbers which are coming in. So it is very important to lock in those YTM at the right time. So to my mind, in the debt funds, going with a lump sum investment makes sense. But yes, if you are working towards making a short-term corpus and want to build good habits, maybe one can start SIPs into debt funds also, or one can go for hybrid balance advantage fund SIPs also.
So that will be all. I'm sure there are a lot of other aspects of, planning your investment to an SIP, which we have missed, but then that will be a round two with Tarun on the basics of SIP. Thank you so much, Tarun, for now and explaining our viewers in detail about SIPs. We will slip into a short break, but then more to come after that.